So this interest rate environment and this all of these things that we've talked about today, what does this in turn mean for the bond markets in these developed countries, especially on the long end?
Yeah, so we've seen over the course of the year a bit of a repricing and recognition here of the fact that we're probably not going to see the magnitude of cuts that were hoped for coming into 2024. And that sort of repricing has brought bond markets higher, and the pushing out of cuts has brought yields in aggregate higher, though that's mostly been a reflection of the fact that people shifted their expectations of growth. So like coming into 24 in the US, actually growth expectations were less than 1% real growth over the course of the year, which is pretty weak in the scheme of things. And that's now shifted. And, economist expectations, which, aren't perfect, but kind of give you a sense as to what people are thinking, are now that growth in the second through fourth quarter is going to be above 3% real. 3% real growth in the U.S. economy right now is pretty strong. I'd say that's quite a healthy growth rate. That's mostly been that shift was in part what drove equities higher. But now expectations are very elevated. And it's what in part drove, the 2-year interest rate to be higher than where we were when we started off the year, the short end of the curve. The long end of the curve is interesting. I think in part because we still haven't, while yields have moved up, it's mostly been a function of the repricing of short rates, not really a repricing of what we call the term premium. So that's the amount of expected return that you receive from holding longer term bonds relative to shorter term bonds. Mm-hmm. And that's typically driven by sort of the big picture macroeconomic environment in terms of expectations of growth and inflation. And right now still remains basically at a 15-year average level, at, depending on your model, roughly a 0 term premium in bonds. And that's unusual, considering the fact that growth today is a lot better than it has been in much of the last 15 years. And inflation is certainly elevated to where it's been in the last 15 years. And so that's really the place where you haven't fully seen the repricing of higher growth and inflation expectations get priced into the markets. I think in part because people are looking at nominal yields and saying those nominal yields look pretty high relative to what I know. And I think in part the fact that the rest of the world has been a bit weaker is creating a lot of demand from those investors for higher yielding US bonds, though that has starting to fade as those economies are not nearly as weak as what people have expected.
Mm-hmm. So what do you think explains how the US avoided a recession in the last year, like many were predicting? And what is that? How do you see that resilience going forward?
Well, I think it really comes back to that income-driven dynamic, and income-driven cycles. I think too many people thought we were in a credit cycle and didn't recognize that we were in an income-driven cycle. Mm-hmm. And so they looked at the sharp rise in short-term interest rates in particular and said, hey, look, we've got to have a recession because whenever there's a rise in rates, typically we have a recession. And that's totally right in a credit-driven expansion. But we had this income-driven expansion, which it's the reasons for which we've talked about already to some extent. And that created a lot of resilience. We have a very resilient U.S. economy, I think in part because of we had a big restructuring of particularly households and businesses following the global financial crisis, where, borrowing is just much less of a big part of the day-to-day equation in terms of how people finance their spending. And so that's created a lot of resilience. The annoying thing for the Fed is it's created a lot of resilience, but it's also created much less sensitivity to monetary policy. And so what's happened is it's almost like, the flip side of the benefit is the challenge for the Fed. And so I think that's basically what we've seen and been an important driver of that. And I probably would would be remiss not to at least acknowledge that part of the reason why we could get to this income driven expansion was the fact that there was so much fiscal intervention in the COVID period, in the immediate post COVID aftermath, that helped bridge that gap in terms of incomes between a period where prices rose a lot and until incomes caught up, income growth started to catch up. And so that put us on a path to then get, that was over the course of a couple of years, which then put us on a path to then be able to have this income driven expansion that we've seen.